Well, good morning, everyone, and welcome to the Cordis Global Medical Technology Fund Annual Investor Update. Really appreciate you taking the time to join. For those of you who I have not met, my name is Michael Cartmel. I'm co-founder and CEO of Cordis Asset Management. Also on the call today is Jacob Salamaia, the Cordis Global Medical Technology Fund Portfolio Manager. Let's begin, and let me tell you what we're going to do today. We're going to do a review on the year that was, and sort of outline the exciting growth potential of the fund. This is going to become an annual tradition, that is opening ourselves up to investor questions in a synchronous public forum. On that note, thank you to everyone who did submit their questions ahead of time. We'll endeavor to get through as many as possible before the half hour is up. Any we don't get to today, we will send you the responses or call you on the phone with an answer. Our goal really is for everyone to be on the same page, and we really believe our best work will occur when you, our investors, understand what we, the fund managers, are doing, and probably just as importantly, why we are doing it. Okay, so before I hand over to Jacob for the update, the standard disclaimer. That is, this is general information only and should not be treated in any way as investment advice. All important information, including our PDS, can be found on our website. So without further ado, let me hand it over to Jacob to run through our what and why. Jacob, please.
Great. Thank you, Mike. I'll jump right in today with a key part of our why at the fund here, which was the origination of how we came to be. So the idea actually came from medical professionals that were in a hospital operating theatre rather than an idea out of a Wall Street trading report. Now, that foundation was very important in equipping the fund with insight into medical technology that continues to provide our competitive advantage today. So running through the investment funnel that we work with, at the top level is healthcare, where there's an insatiable demand driven by the global aging and wealthier population, which is demanding better medical treatment. And importantly, that is a demand that does not pay heed to the economic cycle. A level down, we move into medical technology, where the efficacy, safety, and financial benefit to a stretched healthcare budget is really driving faster growth than the rest of healthcare. Now, that medtech growth tends to be concentrated into what is typically a natural oligopoly, where there are high barriers to entry, both financial and regulatory, which really protect and drive profit in medtech. Over the past 10 years, that has driven a level of outperformance where medtech has returned over 15% per annum. And that is a growth rate that we believe is still only in the early part of a long-term tailwind. And then finally, to harness what we believe is a really great idea, we've put together an investment team backed by a one-of-a-kind medical advisory panel that are really deeply integrated with our investment approach. So together with that medical panel, we've built deep subject knowledge in medtech and used what we refer to as our layer of medical due diligence as a differentiator in our investing. Now, that approach, grounded by that layer of medical research, is what we use to actively manage the portfolio to provide exposure to high growth, high quality medtech returns with daily liquidity that is only found in the public market. So that is our why and our how. Now, what about the numbers? How do we do? In the past year, in FY23, we returned just over 16%, doubling the benchmark return of about 8%. While performance is ultimately what we strive for, it is an outcome rather than an input. And I'll touch on two important inputs into our investment approach in a moment. But before I do, I just want to outline that while our FY23 numbers were very pleasing, the 2-year returns of the fund since inception remain flat, and we're not yet claiming victory. We don't want to be evaluated on 1 year of good performance any more than we want to be judged on 2, because we are really investing with a longer term time horizon than that. So while we made mistakes in our investing in both FY22 and 23, we learned a lot from them. But the big divergent outcome between the two, we largely put down to the rolling global hospital closures that occurred right from the beginning of the pandemic all the way through to mid to late 2022. Now, that period saw the medical technology that we invest in gathering dust on the shelves of shuttered operating theatres. But because we don't believe that a global hospital closure like that is bound to happen again, or they are very, very rare, and the patients that required the treatment didn't go away during that period, we believe that over the long term, if we're able to keep true to our investment approach, performance will follow with repeatability and regularity. So on that note, two of the key aims that we try to achieve when investing and managing your portfolio are high conviction investing and a low turnover portfolio. So the first aim is to be high conviction investors. In that regard, we only hold 22 companies in the portfolio, 21 of which we've held from July 2021 when we launched, compared to about 1,200 in our benchmark. That means that every portfolio in the fund has a really meaningful impact on the outcome. We also are able to know each portfolio company deeply and intimately, and we would require that same depth of knowledge for any new addition into the fund. Now, that isn't to say that we'll never have more than 22, but new additions do need to meet our demanding criteria to get into the portfolio. The other thing to note is that by the very nature of medtech, it does lend itself to long-term investing rather than short-term trading. And something that we are quite good at is understanding the long-term natural dynamic of a medical condition and the medtech treatment and how it will change a paradigm over time. If we continue to get that part right, we can build large positions in the fund with high conviction and a long-term outlook. Now, of course, the 22 companies in the portfolio will change over time, but we will always maintain our discipline around investing in companies for the long-term compounding opportunity rather than short-term trading volatility. The other and harder aim is to keep portfolio turnover low. If we achieve our high conviction goal, we're already a long way there, but this one is particularly important to call out because we want to minimize the amount of your investment that is paid out in capital gains and commission to a third party, which would directly affect your return. In that regard, our voluntary turnover of negative 2.8% is a number that we're very proud of. Voluntary turnover is defined as any dealing not caused by an application or a redemption. And our negative number here implies that throughout the year, we've been very disciplined with our voluntary trading, very prudent with our cash management, and most importantly, very lucky to have investors like you who've bought into the long-term thematic of what we're doing and have applied for minimal redemptions. And on that note, we do owe each of you a big thank you for that. And then finally from me, before we get to the Q&A, an important update on the operational part of the fund. Earlier in the year, we were re-rated by SQM, again achieving a 4.25 superior rating. That rating is a high investment grade and puts the fund in the top quartile of all rated managers on the platform. We were also approved for inclusion on the Colonial Edge and WRAP investment menu to go with the other 5 up there on your screen, really growing our reach to all new and current investors. So in summary, we do believe that we're an investment fund with the deck stacked in our favour. The desire to live longer and healthier, the imperative for more effective medical treatment, and the need to support all of that financially really leans heavily in the favour of medtech. If we can continue to harness that with our demanding investment approach, we believe that our investors, myself, Michael, and the whole team here included, will enjoy resilient growth over many, many years to come. And with that, over to you, Mike, in the Q&A.
Thank you, Jacob. Very well put and nice and brief, which was the instructions are good. All right, so on to Q&A. Thank you to everyone who sent them through ahead of time. I noticed some of those folks aren't on this call, but that's okay. We'll share this with them anyhow, and I think everyone can benefit from seeing the responses to these questions. First question is, what company in your portfolio are you most excited about? This is without a doubt the question we get asked the most, so we decided to start with it today. The company that we are most excited about, without a doubt, is Inari Medical. So Inari are a US-based company with a market cap of circa 3.5 billion. They design and manufacture device-based solutions to remove blood clots from veins and arteries. So when we look at Inari, we, as for every company, we go through our investment approach. And the first layer is always that medical due diligence that Jacob spoke of. So the formation of blood clots, that is DVTs or pulmonary embolisms, whereas Inari is the leading global player, it is indeed a large and really underpenetrated market. The current paradigm treatment for folks who get these conditions is lifelong course of blood thinning medication, or indeed if it's an acute admission, they will receive a short course of, I won't say dangerous, but not without consequence, pharmaceutical agents to rapidly thin the blood and break up the blood clots. But this is being sort of rapidly replaced with this idea of mechanical thrombectomy, that is mechanically or physically removing the clot, which, to put it simplistically, is rather akin to taking a small vacuum cleaner and sucking out the clot, or using a small basket that you put in through the arteries and removing the clot that way. Inari is actually the only pure play company in this space, and they do have the most comprehensive body of clinical evidence backing up their technology. So after we did the medical due diligence, we then looked at the financials, and Inari really impressed just as much there. So their top line growth is sort of almost doubling every year for the last 3 years, and they run at a gross margin of 88%. So that's indicating a really supernormal pricing power and high product desirability. This growth is backed by them having a debt-free balance sheet. So management really does have the flexibility to invest and grow further without worry. So with these catalysts in place to grow the core business, including the fact that they haven't really pulled the levers on international expansion, and keep with their forecast for profitability break even mid next year, we are really comfortable and excited for the outlook for Inari over the course of the next few business cycles. So the next question is, you haven't added many holdings to the portfolio since inception. What does it take to add a new company? I'll throw this one to Jacob, please.
Great, Mike. So this one is a pretty good opportunity for me to run through, again, in a little bit more detail what I touched on before, but that high bar of quality that we put on bringing new ideas into the fund. So the first and most important thing to note here is that when we build a position in the fund, we really want to own it for the long term. Of the current 22 in the portfolio, we've held 21 from the day we launched in July 2021. Going hand in hand with our high conviction investing, that long-term nature does create a high hurdle. But I don't want to confuse that idea with a lack of research activity or a lack of opportunity for the fund. So along with the companies that we've got in the portfolio at the moment, we've got a handful more that are on our radar that we've researched in depth and are patiently waiting for the right opportunity to enter. On the left, I've outlined a few points which are what we call our buy discipline, which include a really simple thesis about why we've bought the company, a minimum quality score on our internal ranking, a valuation discount, and then the most important thing is to be patient. And that all really does help to ensure that we maintain that really high quality portfolio. On the right, I've got 3 companies that we've looked at over the past year and further back, but for a variety of different reasons have not included in the portfolio yet. Going through them one by one might just help you get an insight into the way that we think about including a new company in the portfolio. So at the top, Stryker is the global leader in orthopedic implantation. It is a really high quality company dominating their area of the market. They've got a great management team and a wonderful capital allocation track record. So that would beg the question why we aren't in it. And this one is purely a question of valuation. We are always happy to be patient and wait for a more appropriate entry point. And that really is to protect the downside risk of any investment. So we'll patiently wait and hope to get into Stryker, but yeah, patience is the name of the game there. Looking at Penumbra, that is the other leading mechanical thrombectomy company, the other half of the duopoly to what Michael talked about with Inari Medical. So we really like the area, as you know from our investment in Inari. We do like the Penumbra technology and their position in that market. But the issue here is that we haven't yet got close enough to management. That's a relationship that every company in our portfolio we want to build up and really get to know management intimately, because ultimately they will be the steward of your capital. And if they were included in the fund, we want to know how they would think and act, particularly under pressure. So that is an ongoing thing that we'll continue to work on with every company in our portfolio, but particularly Penumbra, that kind of relationship with management. So the third one is a company called Cardiovascular Systems, which was an independent high-quality medtech company that we had fully evaluated throughout the year. They had a great product pipeline that we really loved. However, while we were waiting for milestone achievements to turn product pipeline into development and revenue, another portfolio company, Abbott, came in and bought them at a small premium to market. Now, rather than be disappointed that we missed out on that little premium, we actually took that as validation of the research and discipline that we have in our approach. Abbott is a much better vehicle for that company to develop and grow their pipeline because of the financial backing and their network. And we retain exposure to the company through our position in Abbott. So really, to sum up, by our very nature as investors in medtech, we'll always maintain that discipline around investing in companies for the long-term compounding opportunity rather than short-term trading volatility. And overall, we do view our pipeline for portfolio growth as very full and, quite frankly, a very exciting opportunity in the years ahead. And we do hope to add a few more companies to the portfolio, but it won't be at the detriment of lowering current portfolio quality. So we'll remain patient as we always have been. Mike?
Thanks, Jacob. Well answered. Next question is another one we get asked quite a bit, even outside the context of our current investors, is do you plan to increasing your exposure to Australian medtech, that exposure being pretty much nil at the moment, as in we have no Australian listed companies in the portfolio?
We've got ResMed, small holding.
I do apologize, ResMed.
A little bit.
So in short, it's no, we don't plan on it. And let me explain why. We invest globally, and we're completely agnostic to geography, regulatory constraints notwithstanding. It just the geographic location of a company really doesn't play a part in our decision making, because ultimately it doesn't affect the outcome of production or ability to generate returns of the company. So we've put together two comparison pie charts here. The left hand is showing the spread of where our portfolio companies are headquartered. The right hand side is showing the geographical spread of the revenue, of where they generate the revenue. Apologies. So you can see the left pie is dominated by the US, which is indeed the global hub of medtech development and the place where all of these funding is readily accessible for these companies to flourish. And the unfortunate reality is that a lot of great Aussie medtech has to go offshore, particularly to America, where funding is just more readily available. The chart on the right shows the revenue spread, and this is much more evenly distributed across the globe. albeit still weighted quite heavily to the States. We focus a lot more on that chart on the right, where and how the revenues are made rather than where the company HQ is. So back to the Australian part, we would really love to invest in more domestic medtech. In fact, we've looked at a couple of local IPO offerings this year in the medtech space. They came close, but they didn't quite meet our strict inclusion quality criteria. They indeed remain on our wait list, but I can assure you that where they are listed, i.e. they're Australian-based companies, doesn't play a role in them getting into the portfolio. We've just had a live question too of going back a couple about Inari, is that Inari is currently down around $20 in the last 12 months. Do you see good value? Not answering, I don't want to sound like I'm avoiding it, but we currently have a higher price target than they're currently sitting at, and we do see value in the company, but not advising that they are definitely good value to buy right at this second. But we're very happy with buying in at this current price for the portfolio. Okay. So next question. What stocks have been the biggest contributor and detractors from the fund in the last 12 months? Jacob, since you put together this cool looking bubble chart, I'll let you answer.
Great. Yeah, this is actually my favorite chart. And I hope that the investor who put forward the question hadn't read the FY23 report, because I did try and explain it in there, but obviously didn't do a good enough job. But let me have another go with the chart here, because I do think that it is very helpful. But there are three important bits of information on the chart here. Along the horizontal, it shows the individual stock return. On the vertical, it shows the individual portfolio contribution of each company, how much they generated in terms of the overall portfolio return. And the area of each bubble is the size of the position in the fund, where a bigger area is a larger position in the fund. So in a chart like that, you want all your companies gathering toward the top right. And the first thing to note here is that we had three of our bigger positions clustered in that top right corner, including our biggest contributor for the year, which was Dexcom, that Mike will touch on in a moment. But that just shows that really our high conviction investment ideas are working, or did work in FY23. Takeaway number two is that all of the companies, the majority of the companies are in that top right-hand quadrant, albeit more toward the middle, and are typically all positively contributing to the fund. And the third takeaway is that we only had one major negative contribution, and that was Tandem Diabetes Care, which Mike will also touch on in a moment. But the most important thing, or the most interesting takeaway for me, was that the two companies in top right and bottom left both come from the same medical end market. Now, the market for medtech diabetic treatment is one that we look at in depth and have a real good handle. We think we have a really good handle on it. And this goes back to what I touched on earlier with that level of medical due diligence and how we do all of that before we even open up a financial statement or annual report. So here, the medical background that we did revealed a market that is highly correlated with one of the key demographic tailwinds driving the whole fund, which is the aging population living a more urban life, eating a poor Western diet. So the numbers here in front of you showing the huge growth in the diabetic population. And then on the right, we've got the associated cost with the diabetic population on the healthcare budget. And they've got nearly 2.5 times higher cost than patients without diabetes. So you can imagine the impact which that will have as we head out to 2045 there in the right column of that chart. So this is really an issue that we need to nip in the bud. And the med tech solution to the diabetic problem are two tiny pieces of equipment called a continuous glucose monitor and an automated insulin pump. Combined, the monitor pump coordination really provide what we call automated insulin delivery, removing the need for a diabetic patient to frequently finger stick and self-inject. So Mike, why don't you talk about the two companies?
Thanks, Jacob. Yeah, so let's start with the good. The biggest contributor to the fund this last financial year was a company that we've written a lot about, that is Dexcom. So Dexcom is a leading player in the continuous glucose monitoring market. That is the one leg or one section of the the technology-based management of diabetes. So as you can see on the right, the product, the Dexcom monitor, is no bigger than sort of a watch face, and it feeds live data directly to a smartphone. And what it does is it's eliminating the need for a diabetic person to constantly be doing finger sticks to get their blood glucose readings. Apologies. The monitor market is a three-way oligopoly, in which Dexcom has the best clinical data as measured by the body's time in a healthy glucose range. In FY23, the company had their new generation monitor approved and rolled it out globally. And they also had key reimbursement updates and positive decisions in America, which we should and will provide another leg of growth. This investment idea has really sort of been a great story and validation for us, because the company is coming off a pretty weak FY22, a period which we used that low valuation to build a position to make Dexcom one of the top 3 holdings in the fund. The FY22 weakness was probably due to the market's perception or negative perception of the reinvestment in the core business, which cramped margin growth. In in FY22, as you can see in the chart above, indeed resulted in Dexcom being, and that market condition resulted in Dexcom being a major detractor to the fund. So while the market punished the stock for the short-term margin hit, we held our nerve, stuck to our investment decision-making process, holding our position, indeed building our position in Dexcom, and pleasingly the result of this being a great contribution to the fund's performance in FY23. So now on to the bad, I won't say the bad, the biggest detractor, that is Tandem Diabetes Care. So Tandem are one of the leading players in the insulin pump market. That's the second piece of the device-based diabetes treatment. There's the monitoring and the pumping of the insulin. So Tandem's T-Slim line of pumps currently enjoys about a 30% market share of this huge and growing global market. Tandem's pump, which you can see on the screen up in the top there, is about the size of an iPhone or the big iPhone Max, and it stores a small reservoir of insulin, integrating directly with the Dexcom and Abbott devices, directly to automate the timing and sizing of insulin delivery. The pump market is no doubt going to get more competitive, but that being said, it's still an oligopoly that takes about 90% of market share and has significant barriers to entry. So it's really our opinion that Tandem was overly punished in the last year for competitive launch of competitors' new generation pumps. From one of the other players in the space, that is Insulet, in which we also hold a not insignificant position in the fund in. So the innovation pipeline in the pump market has historically been very cyclical. And indeed, we can see this happening again now, because Tandem just had their next generation family of pumps, the Mobi. You can see pictured on the screen there, that's significantly smaller next to an iPhone there, approved by the FDA this month. In response, the stock is up 50%. This is before this new model has even begun to generate revenue. It's available to the end market. The other factor weighing on Tandem was another case of reinvestment in the core business being what we think overlooked by the broader market. This investment including 2 pieces of long-term focused M&A, which will make Tandem, a more competitive long-term player, but it came at the cost of short-term quarterly reporting. So we view the current pricing of Tandem and the situation as very analogous to what happened with Dexcom in FY22. And we're using the current weakness as an opportunity to build a position and really anticipate Tandem is going to create wonderful value for the fund over time. Just looking at the time, we're already 1 minute over. So we'll skip through the remaining questions. Needless to say, this presentation, the slides and the recording of which will be available on our website. But I would just like to take this time to thank you, all of those attending. Thank you for remaining as investors in Cordis, and onwards and upwards for the next few years. Thank you.
Thank you all. Have a great day. Bye.